right, as more people are rolling in, thank you guys for joining me today. I am super excited to, first of all, formally for a lot of you, make it clear that Summit funding is no longer. Was not a choice. Summit made the decision to merge with CrossCountry Mortgage. I am a grass is greenest where I water it kind of guy. I watered my grass at Summit Funding for almost 15 years and made the decision to just stay. And Summit Funding made the decision to move us. And so for that reason, we've made the move to CrossCountry. And let me make it really simple. I didn't know how much better things were as far as the programs and the things that we can do for you. And so that is where I'm focused today on telling you what makes us different. There's lots of things. I'm going to quickly say we've got an amazing reverse mortgage program, better than anything that I've seen anywhere else. We've got amazing jumbo programs that I haven't seen anywhere else. Our renovation programs are great, but non-QM is what I want to talk about today. It is the fastest game changer to helping you get paychecks that you couldn't get before. So let's dive in right now and really understand what this is going to mean. All right, so first of all, who am I? John King. I just gave you the quick introduction. 26 years in the mortgage industry, and my number one focus is to help you get more deals done and take care of your clients. All right, why CrossCountry Mortgage? Quick overview. CrossCountry Mortgage, first of all, is we are a direct source for non-QM mortgages. I'll explain what that means in a second. And we are the number one retail mortgage company in the nation. There's only two larger mortgage companies, and they accept loans from brokers. So that's United Wholesale Mortgage and Rocket. We are the largest when it comes to loan officers working for the company, the number of loans that we did, and that matters. And you'll see today why that matters. So we offer everything. This whole list, I'm not going to go through all of it. Land loans is one of them that I never offered before that we have. We got a lot more down payment assistance programs than I've had. We've got a lot of home equity loans and lines of credit. I previously had 3. I now have 14. I have 14 different home equity loans and lines of credit. So again, game changer on the number of products. But why are we here today? We're here about what I'm going to call non-QM, but it's really not. It is our portfolio program that takes non-QM on steroids. But I want to start for some of you, you may not know what non-QM is in the first place, or you may not understand it under that thinking. So first of all, it's not subprime, but it rhymes with subprime, meaning that it's different ways of looking at how we document the client's situation and take appropriate common sense look at what they're trying to accomplish. So non-QM helps people that, again, self-employed is a big deal. Okay, helping people who are self-employed. Bank statement loans are the number one non-QM product out there. And we'll kind of explain some of that. People who are asset heavy, people who don't have social security numbers, investors. That's basically what non-QM is. But here's where I want to focus. What makes us different? So this is where you really got to start listening to understand how what I'm saying today is different than anything you've heard before. So first of all, number one retail lender for non-QM. We have 3 levels of non-QM programs. And I want to explain this so you understand. Level 1 is what everybody else has. We have it too. And that is, there are banks, there are insurance companies, real estate investment trusts, mutual funds that want to invest in mortgages but get a higher return. And so they're investing in these alternative mortgage products. Okay, I know it sounds like 2007 and it rhymes with it, but it is not anywhere near like what it was in 2007. Way smarter how we're going about doing these loans. Now, we call it our signature platinum. And that means that it is, the guidelines are pretty straightforward. There aren't many exceptions to the guidelines. When I was at Summit Funding, we had 3 different investors. Now, investors in my world as a mortgage banker means that we have an internal relationship called correspondent lending. And that internal relationship means we underwrite it, we fund the loan, and then we sell it to them later. Okay, when you talk to a lender today about these non-QM loans, they're either a broker and they have no control over it, they're sending it to an outside company, or they are a correspondent lender, in which case their company has 1, 2, 3, 4 different investors who each have different sets of guidelines and each have different varying interest rates. And they have to figure out, hey, do you fit into box number one for this investor because they're my cheapest? If not, we got to go to this one that's my most expensive. Oh, wait, I locked you on this guy, but you don't meet one of his criteria. I've got to jump over to this other guy. Like it's very difficult to navigate those waters, and you run into a lot of problems. And the ability to get exceptions is almost zero because it's not your money. It's money that we're borrowing through a different source. What CrossCountry Mortgage has done in this level is we have this program. These are our best interest rates, but we make them use our guidelines because we're the biggest, and a lot of banks are coming to us saying, please, will you lend our money? And we've stopped saying, sure, give us your guidelines. We've said only if you accept our guidelines. So we have our guidelines. We make no exceptions to this tier, but we get the best interest rates from all. We have literally 18 different banks right now that follow our guidelines. And every day one bank is a little bit cheaper than the other because the appetite for these loans changes from day to day, from bank to bank. And so when we only had 3 or 4 of these companies at Summit Funding, when one of them said, I'm kind of slowing down a little bit, I'm full, I got too much, then we're in trouble because now I have to switch to another company that maybe their guidelines are different, and now I have to re-underwrite your loan. Well, here, everybody follows the same guidelines for this platinum program, but I pick from whoever has the best interest rate the day I lock. Game changer, okay? But here's what's more important. Is when you don't meet those guidelines, every other investor, every other lender is going to say, ooh, I'll ask for an exception. Let me try. Maybe I can convince the underwriter. It's almost impossible to do. Well, we've got our own portfolio of money. Our company is owned by a billionaire who said, I want to own this market. And so he's putting up his own money as a portfolio program, meaning I don't care about what other investors want. We write the rules and we make the exceptions. Now, we sell a lot of these on the back end because we've got a lot of people come to us saying, hey, we like what you're doing. We want a piece of that. But our expanded program is just that. It's expanded. I call that our portfolio. This is all programs that will make common sense reviews of your file. Okay, we have our money, our rule book, and the guidelines are pretty generous, and we continue to make them more generous. But here's the biggest key, level 3. We make exceptions to this level 2 all the time. Signature Expanded, half of the loans we do under Signature Expanded have an exception. Now, I want you to understand exceptions in lending. It's basically like your kids saying, hey, can I go out with this friend of mine that I just met at school? Well, I don't know. What are you guys going to do? Well, we're going to go to the movies, and then we're going to go drive around for a while and hang out. Okay, well, when are you going? Midnight. Yeah, I'm not sure I'm comfortable with you going out with somebody I don't know, driving around with them at midnight. That's a no. Now, maybe it was only 2 of those things it might be a yes. That's called layered risk. If they said they're going out with somebody you've known for the last 15 years, and they're going out at noon, and they're going out to whatever the third thing was, you're totally fine with it. You might forgive one of those, but you're never going to let them do all 3 at the same time. I have been shocked at the number of exceptions I've gotten here at CrossCountry Mortgage. Basically, I said, oh yeah, I know they'll do that, but they already gave us 2 more exceptions. There's no way they're giving me another one. And they did. Now, each exception costs a little bit more in fee. So there's a cost. These are not free, but it makes sense. And that's the key to what we're doing, is make sense lending. This right here is the most important thing that you need to know. If you are talking to a lender about any of these programs and it's not me, you're talking to the wrong lender. Now, maybe you can work with somebody else at CrossCountry. We all have access to this, but I am the best. So what's my point? My point is I'm going to show you what non-QM is, but understand we have 3 layers deep that every other lender only has 1, and it's a huge difference. So what is it? This is a big picture of it. I'm not going to read through all these. I am going to jump through a few of the highlights, but these are some of what does non-QM mean? And this slide is showing you what that means, what different types of programs are. And I'm going to dive into a few of them, but I want to stop for just a second. I want to make it clear. If you guys have questions, post your questions in chat. If you have hey, John, does this situation work for you? Post it into chat, okay? I'll get to all of your questions. I want to answer all of your questions. But I want to start with addressing something very direct. Interest rates. I know when I get emails from lenders, oh, we do this loan program and we'll be able to forgive all this stuff. And you're like, yeah, but you're going to charge 10%. The truth is, risk equals return. Rates are higher when a loan is riskier, but there's a lot of people that don't have that high of a risk. I ran some numbers this morning and I looked at somebody who was using a bank statement loan. Now, bank statement loans, I'll explain in a minute what they're used for and why, but a bank statement loan this morning for somebody putting 25% down with great credit was only about a 1/4% higher than what it would be if they did a Fannie Mae conventional loan. So Fannie Mae conventional loans, mid to high sixes right now. We were a 1/4% higher in rate for doing a bank statement loan that qualified somebody that couldn't otherwise be qualified. We're not talking about 2% higher in rate, okay? Investment property loans. I'm going to talk to you about what the DSCR loan program means if you don't know already. Investment property loans, the interest rate was actually equal to the interest rate that Fannie Mae was charging. Why? Because Fannie Mae doesn't want investment properties. Fannie Mae doesn't want second homes. And so they've made them way more expensive. The bump in interest rate for a second home or an investment property is huge. Well, that means that our programs basically are equal to what you would pay for a second home or an investment property, but the documentation is so much easier. So I do not want you to be thinking, oh my God, John, that's great that you're talking about all this, but my clients aren't willing to pay 9 or 10%. Now, do some of these loans come with a 9% interest rate? If it's super high risk. I talked to somebody yesterday who had a client that bought a home a few months ago. So they didn't know about this program. We didn't have the conversation about it by then. The client went with a hard money loan, double-digit interest rates. Why? Because she had a bankruptcy a week or a month before, like very, very recently that she had a bankruptcy. I said, the first thing is technically that might qualify for FHA. Sometimes FHA can do something immediately after a bankruptcy. But I showed her with this program, we could have done that loan and the interest rate would have been 7.9% with 2 points. Okay, 7.9 with 2 points versus the 10.5 with 3 points that she paid for going after a hard money loan. So this is like soft money. Okay, it's not hard money. And I want you to think about that when somebody says, I need to go hard money. Maybe not. Okay, the one thing we don't forgive here is property condition issues. So hard money is great when you got a property that is falling apart. I have renovation loans for that, but renovation loans require you to prove all of your income. But this forgives a lot when it comes to credit history, when it comes to proving your income, and I'm going to show you what that means. But the bottom line is the rates are really good for what you're getting. And if you have somebody who's looking at hard money, talk to me first. All right. So let's talk about some of the things that this really means. First of all, flexible qualifications, different ways of looking at how we calculate the income. This one's big. Common sense underwriting, literally common sense that doesn't exist in the mortgage world until now. Lots of exceptions. This says 35%. Actually, last month it was 50%. Lots of exceptions. Streamlined documentation. DSCR loans, if you know what that is, and I'll explain it in a minute, can close in a matter of weeks. We shortened our seasoning on credit issues. That's like the bankruptcy I was talking about a minute ago. Interest only. We can do interest only on 30 or 40-year loans. Okay, so again, somebody who's in a pinch right now, I had a referral actually from somebody on this call, in this meeting, who referred me a client yesterday that owns a lot of properties. And they're in a pinch right now. And so they were asking me, hey, John, can we do interest only? I'm looking for the lowest payment I can have right now. Absolutely, I can do interest only. Condos, especially the ones that don't meet Fannie and Freddie's guidelines, this is all about that. Non-warrantable condos, we are great with. Okay, so that's an area you got non-warrantable condos, meaning you don't meet Fannie or Freddie's guidelines. I'm great with those. And here's an important thing to investors. Every one of my expanded alternative programs of my portfolio, all of these programs can close in an LLC, a trust, or a corporation. Now, you're still putting your personal credit on there. We're not doing the credits of the LLC, trust, or corporation, but the ownership of the property can close in an LLC, a trust, or a corporation 100% of the time with these programs. Okay, what's a bank statement loan? I'm going to go super quick through this. First of all, it's an alternative for self-employed people to use bank statements instead of tax returns. So why? Because the truth is, we know that you've got great CPAs that are showing you a lot of write-offs. And what we're doing is we're actually taking your deposits over the last 12 months. Okay. So this is a great program. And what has traditionally happened, and this is an example of what's different with CrossCountry compared to every other lender. Every other lender says we take half of your deposits and we treat them as profit. That's pretty generous. If you deposit $100,000 over the last year, then we consider your income $50,000 of profit, which your tax return probably shows a lot less than profit. But we take it one step further. If your CPA will confirm for us that you are a service-based business, and if you have 0 employees, okay? So many of you guys are service-based businesses. You're a realtor, you're not selling a product. Yeah, you're selling the house, but you're not receiving the money from the house into your bank account. You're a service-based business and you have no employees. Then we get to count 85% of your deposits. That's your CPA and your financial planner, your insurance guy. Small businesses, 85 cents of every dollar they deposit into their business account, I get to count as profit. If they have 1 to 4 employees as a service business, I count 30% as expenses and 70% as profit. But then everybody else would count it 50-50 like normal. That can be the difference between qualifying and not qualifying by going to the wrong lender. Because every other lender counts 50% automatically unless your CPA writes a letter certifying your expense ratio is lower. And I don't know many CPAs willing to do that. Because they just filed your tax return showing that 90% of your revenue is expenses and you only profited 10%. And now you want them to write you a letter saying that 70% of your revenue is profit. They're flat out lying. I just want them to certify how many employees you have and whether you're a service or a product-based business. That's it. Then I use a lower expense ratio and I qualify more people than any other lender is going to do. Now, these programs require at least 10% down. Rates at 10% down are pretty high. Okay, 20 to 25% down is better. I can go down to a 600 credit score. Rates at 600 credit score are pretty high. So this is where you're going to pay for the risk. All right, I'm going to move quickly. This one's huge. This one's huge. Okay, the asset qualifier loan I have never, ever, ever seen ever before in my career. Okay, I've been doing this for 26 years. I've been around the block. I've never seen this loan. This is the program that everybody says we should have had that is common sense. It is qualifying based upon your assets rather than your debt to income ratio. And all it says, get my cursor back to where I need to be, is high net worth borrowers are the ones that this is perfect for. And I simply say, there's 3 ways for me to calculate it. The simplest way is to say, if you have 125% of your mortgage debts in savings after you bought the house, you're qualified. What does that mean? That means that if you're buying a house and your loan amount is $500,000, then you take $500,000 plus 25%, which is an extra $125,000. As long as they have $625,000 in the bank, maybe that can be 401k, although we have to kind of discount 401k a little bit for the fact that you haven't paid taxes on it. But if you've got money in a trust account, if you've got money in a 401k, some people that can't prove their income at all, I can use this option to qualify them and I don't care about their income. That's common sense. If you have $2 million in the bank, you could pay off my $500,000 mortgage like that. Why am I worried about whether you show on paper enough income to qualify when you literally could pay it off 4 times over tomorrow? This program is exactly for that. So high net worth clients, these are the people who pay cash for homes because they don't think they can qualify for a mortgage. But guess what? They're wasting a bunch of money in taxes because they're paying capital gains on those stocks that they sold. If they pulled money from a retirement account, they're paying income tax on the money that they sold. And they lose the ability for that money to continue growing where it's at. So you have a double whammy. The house is going to grow no matter what. You buy a house for $500,000, it's going to go up to whatever it's going to go up to, no matter how big your mortgage is. But now they also get a tax write-off. These are high net worth people that need a tax write-off. Now, they sell their stock, they're going to pay capital gains, they're going to lose the growth on the money, and they need another tax write-off that they don't get. By having a mortgage, they get that tax write-off. They keep the money they would have spent in capital gains, and their money grows double. Their money grows as the house value appreciates, but also the assets that are still invested in the market grows separately. I know that concept, I went through it pretty quickly, but it is huge. And literally, I can do this one with as little as 10% down, with as low as a 600 FICO score. Very, very forgiving program. Again, the lower you're down, by the way, I can't do a 600 FICO and 10% down. Like there's rules in between here. Best credit scores, we can go to 10% down. We can go to 600, but you need more than 10% down. So I want to make that part clear. All right. Investor cash flow. Most of you should have heard about this, but if you haven't, this is huge. But there's way more than what you think. So an investor cash flow loan is a program, oh, I don't know what happened there. It's a program called DSCR that basically says, I don't care about your debt to income ratio. I only care about, does the property produce enough income to pay the mortgage payment? It's got to be a rental property, and you can't have family living there. Those are the two biggest rules. Most banks say the rental income has to cover at least 100% of the payments. We don't require that. Matter of fact, I don't care if the rental income only covers 50% of the payment. Now your rate's going to be a lot higher because we're kind of like, hey, wait a second, your payment is $2,000 and your rent is $1,000. It isn't covering, but we can still do the loan. There's a lot of people pulling cash out of free and clear investment properties using this program. It's huge. They're buying it they're pulling cash out to leverage either A, paying off debts, or B, like high credit card debt, or B, they're doing it to buy more investment properties, which gives you the opportunity to finance another, or to find them another property, and you just found their down payment money. It's hidden in the property that they have right now. So they pull cash out of that free and clear property. They use that to buy another property. This is used a lot for people who are doing 1031 exchanges, or they maybe wanted to do a 1031 exchange, or you want to help them do it. The problem is they don't qualify for the new property because they don't have the income they had when they bought the first one. All I care about is the rental income on the property that you are buying. I don't care about your other debt. I don't care about your total income or what you show. There literally is no ratios other than how much is the rental income compared to how much is the payments, okay? Investment properties need at least 15% down and a 620 FICO score. Remember, at a 620, you need way more than 15% down. With 15% down, you need way higher than a 620, but this gives you the bookends, okay? Our full doc program, look, full doc, you're like, John, wait a second, this is full doc. Why do I need full doc? I'm going to show you in a second something called passive asset utilization. I have used this 3 times in the last 4 months to save deals. 2 of them died with other lenders. One of them that we couldn't get approved. I knew it going in, but I used this to get them approved. But this is also used for people who maybe they have an ITIN and they can't qualify for a regular mortgage. So you can get them, we can get them into a house with a full doc loan program. There's a program I'm going to show you in a minute called Buy Before You Sell. I do a lot of those full doc. Okay, so full doc, essentially, sometimes it's going to be for somebody that has strange properties. We actually will do unique properties pretty commonly. That's one of the big exceptions that we do is unique properties. Okay, so we do a full doc version. For a national, really quickly, this is basically DSCR for people who don't live or have any residency in the United States. They want to buy a rental property. They want to buy a vacation home here, not vacation home, investment property only. We can do that for them. They don't have to have a social security number. They don't have to have credit. Like there's a lot of flexibility if you have somebody overseas who wants to buy something here as an investment property. This 1099 loan, this is you, literally you, almost all of you are not the broker owner of your brokerage. You are a real estate agent paid on a 1099. So you might think, oh, I need to do a bank statement loan. If I like what John said, because I'm self-employed and I got a great CPA, I don't show a lot of profit. Well, the problem is that I still have to throw away 15% of your deposits if you are a single person, you have no employees, single, not single married, but single, no staff. But with a 1099 loan, because you are paid on a 1099 from another company, I get to count 90% of your earnings as profit. I only have to throw away 10% of your earnings. Guys, that's huge in qualifying you. Now, I'm going over a lot here. I don't expect you to memorize this. What I want you to memorize is John's got a lot of options. John can help my self-employed people, my people that are in unique situations, my people buying unique properties, my people that can't prove their income. I have lots of options. The 1099 is an absolutely amazing program. And it is really, really easy for people like you, like a real estate agent, to qualify. And I get to maximize the amount of your earnings that I count as profit for qualifying for the mortgage. Okay. ITIN, same thing. It's a full doc or bank statement loan. I can do DSCR. I can even do a P&L loan for ITINs. I can do P&L loans for non-ITIN. P&L basically says, look, if you use QuickBooks or some other method to print out your books, we can often use that as long as I see 3 months of bank statements that show pretty close to the deposits that you're reporting on your QuickBooks. So it's a different way of looking at it that allows us to be way, way more flexible in qualifying you. And we do a lot of unique properties. We're going to do manufactured homes. Now, we can do a lot of manufactured homes under conventional loans, but we can do manufactured homes even with these creative income situations. We can do mixed use properties. So I can do a property that it's got to be at least 50% residential, but the other half could be retail. It could be office space. It could be a restaurant. We're okay with that. I'm not okay with other commercial, but I'm okay with retail. I don't know if it says it on here, but I think it's retail, restaurants, and office space are the 3 uses that I can do for mixed use. So lots of scenarios that we can go through here. Here's some really commonly requested exceptions. So I want you to think outside the box here to understand the things that we will do regularly. Like not the, oh my gosh, this is way outside the box. We're making these exceptions all the time. Landlord history. That's a really big one with all of the typical non-QM loans to do a DSCR, meaning to get approved when you are buying a rental property. And all I care about is the rental income. Almost all of them require landlord history. We've got exceptions to that approved regularly. We'll make exceptions of between 5 and 10% above the maximum that's allowed for your loan to value. We're going to make exceptions to FICO. Now, we're not going to go less than 10% down on a primary home ever. We're not going to go less than 15% down on an investment property. And we're not going to go below a 600 FICO. Those are kind of the hard stops. But if your credit score says you have to put 20% down, could I go to 15? Probably. Okay. Declining deposits, can't prove your housing history. The one client that we had multiple exceptions couldn't prove his housing history because he paid cash. He was short on reserves. He was short on his personal contribution because he was getting money as a gift. So we've got all of those that we layered together. Okay. Somebody who, multiple NW condo features. Those are non-warrantable condos. So when a condo doesn't meet Fannie or Freddie's guidelines, a lot of non-QM lenders say, I'll do those. Oh, but you have 3 features, 3 things that are a problem about Fannie and Freddie's guidelines. I won't do more than 1 or 2, so that's not okay. We make exceptions. We'll do exceeding max acreage. We'll do hobby farms. We will do self-employed less than 2 years. We will do multi-unit with an ADU. Like there is so many exceptions that we will do. That's that level 3 where I said platinum, that's what everybody does. We just have great rates on it. Then we've got the expanded, that's our great, fantastic guidelines. And then level 3 is our exceptions that we're making to expanded. This is where deals die, that every lender says, I can do it for you. And then it ends up not working because there's always one little thing that didn't fit the guidelines. And you can get almost no exceptions through these non-QM loans through most investors because they are not the ones writing the rules. They're not the ones holding the pot of gold. We wrote the rules. We get to break our own rules. It's like parenting, right? All right. I'm almost done, I promise. Then we'll have time for questions if you guys have any. So buy now, sell later. I've used this twice already. It's an absolutely amazing way to help somebody that has a home and they want to buy their next home without selling their current one yet. Now, I have an option of doing this with a bridge loan and without a bridge loan. So it says right here in the middle of the page that it's not a bridge loan. It is not a bridge loan, but I have a bridge loan that I can merge with it. Basically, it says, hey, if I do one of our alternative portfolio programs, whether it's full doc, whether it's bank statement, whatever it is, okay, and as long as you have at least 20% equity in the house that you're moving out of, as long as you sign a listing agreement with the realtor or a letter of intent that you're going to list it. Now, if you're doing the bridge loan, you have to sign the listing agreement. If I'm not doing the bridge loan, it's just a letter of intent saying I intend to list within 90 days. And you have to have extra money in savings. Now, here's where the common sense comes in. If the appraiser, because we do get an appraisal on the house that you're moving out of, if the appraiser says the marketing time is less than 6 months on average, then I just need 6 months of the payments on your old house in reserves, extra reserves. All of these programs require some reserves, but I need 6 months extra that says, well, if it takes less than 6 months to market the house and get it sold on average, and your payment is $2,000 a month, then as long as you have an extra 12 grand sitting there to use to help make that payment, where's the risk? This is the common sense part of it. Where's the risk? Because houses in your neighborhood are selling. You have 20% equity. Houses in your neighborhood are selling within 6 months, and you're going to be listing it within the next 90 days. We're golden. In worst case, the appraiser says, no, it takes 8 months to sell. Then we're going to want a year and a half of payments. So it's either 6 months of payments if you're under 6 months of marketing time, or a year and a half of payments if you're over 6 months of marketing time. It's that simple, okay? And I can pair a bridge loan with it. And the bridge loan lets me loan you up to 80% of the combined amount of your current home. The fee is only 1% of the bridge loan. A lot of these buy before you sell programs, knock and fly homes, which we do those too. The benefit of those is it lets you tie them to a conventional first mortgage. This doesn't tie to a conventional. It has to be one of our portfolio first mortgages on the new house. But it's a trade-off because those other programs charge you 2 and 3 and 4% of the value of the home you're moving out of as a fee. I'm charging you 1% of the bridge loan amount that I'm loaning you. And if you don't need a loan, I had one of these I did a couple months ago where the client was a 1099. So I used his 1099s to prove his income, and which I only had to throw away 10%. He worked for Amazon. He was a gig worker for Amazon. He drove for Amazon. He drove for DoorDash. I counted multiple 1099s and I counted 90% of his 1099s. But he still didn't qualify because we had to count the payment of the house he was moving out of. But I used this program. He had gift money that he got from family that he was going to re-gift back to them after he sold his current home. So he didn't need the bridge loan. And he qualified because I was able to ignore the payment on the house that he was moving out of. I have another client who's out of state. I'm licensed in 17 states, and they are in one of the states I'm licensed, and they've been a client of mine for a long time. And they own multiple properties. They've got their primary home, they've got a vacation home, and now they want to buy a new property, but they want to move to the new property before they sold their old one. Okay, and this is a W-2'd employee. She was, on paper, well qualified if she didn't have the payment on the house she's moving out of or didn't have the vacation home. But she has both. And so we utilize this buy now, sell later program, but we combined it with what's called passive asset utilization. And I thought I had a slide about passive asset utilization. I do not. Oh my God, what did I do? Okay, well, forget it. I'm going to explain to you what passive asset utilization is. I cannot believe that I don't have that. So this is a really, really, really big one. As a matter of fact, gang, I am going to stop my share because I am just positive that I have this in a different presentation. I want to show you because this one is actually the other big, big, big thing that makes us different is passive asset utilization. And it's what I used for this client. So give me 2 seconds to grab my spectacles and open up. I had a different version of this PowerPoint, and hopefully it is in that version. Yep, here it is. Let's go right here. And all right, cool. Now I got to share my screen. Hold on 2 seconds. All right. If you have questions, by the way, please, please, please post them into chats. Let's find you guys again. And thank you for your patience. I don't know what happened and why that didn't get in there, but let's go right here. All right. So this one's huge. This is where I'm going to help you save deals that other lenders couldn't do. Nah, you're better off just sending it to me in the first place. Then you don't have to save it from what they couldn't do. But passive asset utilization. I use this for my client out of state because she didn't show enough income. Even if I'm ignoring the payment on the house she's moving out of, she was still a little bit tight on debt to income ratio. And so I used this. Passive asset utilization is when you have a high debt to income ratio, or if we just want to get you a better rate by lowering your debt to income ratio, I'm using extra money and savings that you're not using for down payment, closing costs, or reserves. Now, this is different from that program that says, hey, as long as you have 125% of the balance in your account, I don't care about your other income. This is for someone who barely doesn't qualify. Okay. When you barely don't qualify and you're on a full doc loan, or we're doing a bank statement loan and you barely don't qualify, this will save the deal because I basically take whatever amount of extra money you have, extra money. That could be in a 401k, that could be stocks, that could be in a trust. As long as you've had it for 6 months or I can see where it came from, like a recent sale of a business, I'm golden. You don't have to touch the money. All I do is say, hey, that money, whatever eligible balance that I can use, like we use 80% of retirement accounts because there's a cost when you sell the retirement, when you liquidate the retirement account. Whatever that balance is I can use, I divide it by 7 years or 84 payments. I get to count that money in your income. So for example, someone has $100,000 in a brokerage account, that's $1,190 in extra income. That can look, $100,000 is a lot of money, but for a lot of people who are buying and selling homes, they have $100,000 in a 401k. You've been investing in your 401k for a while. You should have $100,000 in your 401k. If you are in your 40s, you should hopefully be pushing in your late 40s $100,000 in your 401k. Okay, so that person with a 401k, I can add $952 a month in income for them. I don't know if you get where I'm going with this. It is like huge because the difference between qualifying and not qualifying is sometimes just that much. Just they barely didn't qualify. I need a little bit bigger gift. I need this. No, I just need to show that you have more money in reserves, and many, many people do. We actually, as a lending industry, have gotten lazy in not asking, hey, tell me all of your money. Clients don't like to disclose all of their assets because why do you need to know that as long as I have enough money to buy the house? Because I might be able to get you a better deal. I might be able to make this work in a way that you couldn't otherwise do it. That's the key to these programs. That's the difference that I'm able to do that other lenders are not because they don't have these options. All right, let me figure out how to get back. I'm trying to find my chat and I can't find my chat. All right, my mouse is lost. I'm getting old. Zoom. Here's Zoom. Zoom, why are you not being my friend? There you are in chats. Good, no questions. All right, so I'm gonna keep going here. Okay, I went through all of this stuff. Buy now, sell later. Okay, so call me when you hear. This is all that I'm going over right now. The last thing that I'm going over. Call me when you hear these things. Somebody says, hey, I'm self-employed. My CPA is working on my taxes. Most of the time, they're working on it to try and get more profit showing on their taxes so they can qualify for a mortgage. What happens when you show more profit on your taxes? You pay more in taxes. And then in 2 years, when you want to refinance, they've got to do the same thing again. They've got to show more profit again. And sometimes it takes 2 years of taxes to qualify someone. And so they have to show higher profit and pay more in taxes for 2 years in a row to do one loan just so they can go back to normal. And they're also making themselves a bigger target for an audit. The IRS is going to look at people who, well, wait a second, how is it for these 2 years you showed so much more profit? Were you lying then? Or were you lying all of the other years when you were showing less in profit? Why create that problem when you can do a bank statement loan for maybe 1/4 to 0.5% higher in interest rate for well-qualified clients? Okay, so there's a lot of flexibility here that you should be thinking of me when someone says that. When someone says I'm buying another rental, okay, let's talk. Because rental interest rates for conventional loans are stupid high. And we have similar interest rates. Matter of fact, we offer prepayment penalties that make the rates cheaper than Fannie and Freddie's rates. Now, you don't have to take a prepayment penalty, but a lot of people don't refinance their rental properties very often. They're like, look, even if rates drop, it's not worth the fees to refinance it. I agree. So having a 2-year prepayment penalty is pretty easy for someone to accept. We offer up to 5-year prepayment penalty agreements. And I've got a lot of clients who agree that the cost benefit is worth it. I'll stick this out for 5 years because I'm saving so much during that 5 years. Someone says, oh, I got to sell before I can buy a house. Probably not. Probably not. And I have lots of options for that. Someone who says, I'll just pay cash. Why? Like, isn't there something better you should do with that cash? Do you not want a mortgage payment because, hey, I'm retired and I don't want to have a mortgage payment? That's great. Then I'm not trying to get them to do it. But if you're high net worth and you're buying a house in cash for your kids, you actually may be better off financing it. There's a theory about making money, which is never spend from savings, always spend from earnings. And so high net worth people have to think differently. And they have to think, you know what? I could liquidate that savings to buy this house, but I'm paying capital gains on it. I lose the opportunity for that money to grow. And if I do a loan on the property, I don't have those two problems. And I get a tax write-off, and then I'll just pay it down faster through income. That is a strategy that a lot of realtors don't talk to their high net worth clients about. People think, oh my gosh, they can pay cash. That's always better. There's a cost to paying cash. It is not free. So think of me. All right. My lender said no. That one should be pretty obvious. Hopefully none of you say that because I should be your lender, so you don't have to worry about your lender saying no. But if your lender said no, call me. Now, this is, remember, I said I have lots of programs other than this. These programs, you need at least 10% down, okay? 15% down on investment properties. So when somebody says, hey, my lender said no because I'm doing an FHA 3.5% down, and John said we can use that asset thing for income. I can't do that on FHA. I can do some things, and I understand the rules really well on FHA and conventional. I can often get people approved where other lenders made a mistake. But if the other lender is good and understands the rules, my rules are the same. I can't do something that somebody else also can't do because it doesn't meet Fannie Mae or FHA's guidelines. But this, when they're putting a little bit bigger down payment, when they have a little bit more equity, is a game changer because I can do things that nobody else can do because we write our own guidelines. My debt to income ratio is too high. Again, as long as they have a decent amount for a down payment, I can take care of them. This condo isn't warrantable. Well, your client wouldn't say that. But the truth is, you would hear it. You would say, oh man, you can't buy in that condo because it says cash only. Condos that say cash only, this is a game changer. Okay. Again, you got to have bigger down payment, but a lot of people can come up with money when it's the necessary step to get to their goal. It's amazing. I've had so many people who have, once I tell them, hey, the only way this works is if you put 10% down. Okay, I guess so. What do you mean you guess so? Well, my husband's mom said she would loan us or she'd gift us the money, but that's going to cost us a lot emotionally. And I never wanted to owe her. Well, I get it. But it's the difference between getting the house and not getting the house. And so we want to provide solutions, options, ways to say yes that maybe the client says no. Okay. Any of these, text me the scenario. I'll give you a same day answer. We've got a lot of co-branded marketing materials. So if you want to co-brand any of this stuff, it's time for questions. So I'm going to fill right now while I'm waiting for questions. I'm going to tell you, DSCR is not just about long-term rents. The next move in DSCR is going into short-term rentals. And there is a lot of opportunity when done right. And we can use short-term rental income to qualify. I had a client that I talked to 2 days ago who has a couple of properties that are short-term rentals that they've had for a couple of years. They need to pull cash out. I'm able to qualify them using 75% of the rents that their property produced over the last year because they've owned it for over a year. I just have them get out or print out their VRBO or Airbnb history. And then with that history, I take 75% of the dollars that they deposited and they're qualified. That's it. As long as that's enough to cover the mortgage payment, they're done. Okay. If you're buying a property that you want to buy and rent out as an Airbnb, then we use services that run automated rental income calculations because The data is all out there. Way more data about Airbnb rental occupancy rates and rental income per night rates than there are about month-to-month rentals. And so that data is now being accumulated, and I can pull a report that says, hey, in this city, this bedroom and bathroom count, this square footage has a 40% occupancy rate, which is really bad. Okay. There's a certain threshold that we're looking for, but let's say, they're at a 60%, 70% occupancy rates. We're looking for higher numbers there. And this is how much it's going to produce in revenue per year. Okay. So we worry about occupancy rates because if you're in an area that has a low occupancy rate, then can we really trust that? You're going to actually earn that income. But it gives us opportunities to say yes when otherwise we would have had to say no. So if you have questions, you either can unmute yourself and ask the question. I'm going to stop my sharing here. You can type your question into chats. I am done with my presentation. So at this point, it is all about questions. If there are no questions, then we'll get wrapped up here in a couple of minutes. I am going to start doing webinars for consumers that want to buy investment properties. I'm going to start doing webinars for people who want to buy VRBOs. I'm going to start doing webinars for self-employed people that want to understand how to qualify without showing so much money in profit. So look out for those because I'm going to be putting those out there for you to register your client. We'll co-register you with them so that I can track who referred them. You can join on the webinar as well. It'll be multiple realtors bringing people. I'll be bringing my clients as well. But I'm going to do these regularly because there's a huge opportunity for me to help you get more sales. The other thing I will tell you is you need to connect with CPAs, financial planners, and real estate attorneys, estate planning attorneys, and get me into that conversation. Because what I just discussed is a game changer for them. CPAs have people walking in every single day that they're like, hey, you need to buy a house. You need a write-off. Oh, I don't qualify. Or the CPA is being told that they need to show more profit in order to qualify them. And they don't have to. And so some of my best referrals come from CPAs. Financial planners, they're paid for assets under management. How much they have in their asset account is how they're paid. So when somebody comes in and says, hey, I want to take out $700,000 to buy a house for my kids, that actually is taking money out of the financial planner's pocketbook. Now, just like us, they're fiduciaries. They have to look out for the client's best interest before their own. But the truth is, it is often in the client's best interest to not liquidate their investments and pay capital gains on it. And it is often better for them to borrow the money and be able to get the tax benefits that come with that. And it happens to help the financial planner. Estate planning attorneys, they're dealing with estates when people got big inheritances. And now they're like, hey, what do we do with the property? I can't qualify to refinance it out of mom and dad's name. But you just got a big chunk of change and now you're going to pay off the property, but you have other things you want to do with that. And so you just want to take over the loan or you want to buy out the other heirs. This is where we can work together to serve their needs. They're going to, when an estate planning attorney helps somebody with probate or trusts, they're going to be looking at, hey, this property is either going to be sold or it's going to be refinanced and buy out the heirs. And then those heirs end up using that money to buy another home. Either way, there's opportunity for you and there's opportunity for me. And so that's the part that we need to partner together on because what I showed you today goes way beyond what any lender says is non-QM. And the asset qualifier is huge. I don't care about your income at all on a primary residence, second home, or investment property. And the passive asset utilization, the taking, hey, I'm doing a regular full doc loan, but you just barely don't qualify, no problem. If you have some extra money, or maybe we get a gift to help with your down payment, so the money you were going to use for a down payment becomes extra money. See how we can get creative here. And now we've got an opportunity to qualify you that you could not qualify before. Gang, I don't see any questions in chats. I haven't seen anybody who unmuted and said they want to ask a question. I cannot believe that nobody has any scenarios that they want to ask about, but I understand that some people are camera shy. So I'm going to go ahead and wrap up. Thank you, thank you, thank you for joining me. We will be following up with each of you. A lot of you are going to be watching this recorded because we had 55 people register and there's a dozen of us here. So a bunch of you missed it. That's okay. We'll send you a copy. For those of you who were here live, I appreciate it. Hope everybody has an absolutely wonderful day. Remember, I do everything. We have some crazy, amazing things on unique products like this, but we're really good at everything else as well. And I am for sure interviewing for the job of being your lender. So if I'm not already your primary lender or your backup lender, I'd love to at least start by being your backup lender and then earn my way to being your primary. Really appreciate you listening today. Hope you have an absolutely wonderful rest of your day, and we'll talk to y'all soon. Bye-bye.